Hi everyone, welcome back. You're watching The Money Show on ET. Now, as promised, we are going to discuss arbitrage funds today on the show. Like I said, we've discussed equity and debt mutual funds in a lot of detail, but arbitrage funds is something that's a new product. Well, not a new product, but at least new for The Money Show. It's the first time we'll be discussing something like this. So what exactly is it? How suitable is it for you? How risky is it? Is what we will talk about. And today I have with me Hemant Rustagi of Wiseinvest Advisors right here in the studios. Hemant, thank you for joining us on The Money Show. So what exactly are arbitrage funds? Because recently as well, in all the AMFI data that was released, it did show a good amount of traction in arbitrage funds. What exactly are they, Hemant?
Well, Mobina, I think arbitrage funds are quite interesting funds. You did mention about, you already talked about debt funds.
Yeah.
So, investors are always on the lookout for something which is safe, at the same time where they can get higher return. Arbitrage funds is a fund, basically they try to generate return, by looking at the mispricing between the spot price or the cash price and the future price. So basically what happens is, they actually, from tax purposes, they are equity funds. But how it functions is, the fund manager buys a stock and sells at the same time its future.
Okay.
So even though for tax purposes it's an equity fund, it never takes open position in the stock. So you're not taking the risk of investing in an equity. So because the fund manager is buying a stock and selling its future. So let's take an example how it works so that everyone can understand. Let's say the fund manager buys a stock at 10 rupees and sells the future at 12 rupees. Okay, now what can happen? The stock price can either go up or can go down. At the end of the month of the settlement day, usually the stock price and the future price converge. Okay, so you bought stock at 10 and you bought sold future at 12. Let's say the stock price is 13. Okay, so the fund manager will make 3 rupees from the stock and lose 1 rupee in the future because it's already sold at 12.
True.
So the net gain is going to be 2 rupees for him. Look at the other scenario where the stock price goes down. Let's say the stock price goes down to 9. The fund manager will lose 1 rupee in the cash market and he will make 3 rupees in the future. He will still make 2 rupees. Of course, in reality, these are not the kind of margin the fund manager makes.
Of course.
But this is just an example. So clearly there are times where the fund manager has to kind of make efforts to do many more deals than usually like one deal that we talked about. But there are opportunities available as because stock market by nature are volatile. So there is always a mispricing between the stock price, between the cash market and the future market. So there are opportunities available. So clearly what it tells you is that it basically captures the interest component of the stock market. So what it does for you is, it creates stable return. The fund by itself is quite safe, even though it's invested in equity, but it's not taking an open position because it's buying in cash market and selling in future market.
So it looks like it's quite... would you believe that the risk component of this one is a little lesser than equity mutual funds? Because the strategy that you're saying, the fund manager adopts, it looks like, okay, great, there will be some return made in some way or the other. What is the risk component like?
Well, I think there are two risks if you have to look at. One, as I mentioned, the return will come from the arbitrage opportunities. So if the markets are volatile, there are more opportunities for the fund manager to make money. In the stable market, there may not be too many opportunities. Second, usually, as I mentioned, the price of the future and the stock converge on the last day of the settlement. It may not actually happen in reality. So there is a little bit of risk there. If you were to compare this with equity fund, I think this is a much better option during the volatile period. But let me explain that. Equity is a long-term investment. So you invest for 10 years, 15 years, depending on what is your goal. Arbitrage funds are not really long-term investment. Essentially, I would say if your time horizon is a couple of years and you don't want to put money in equity market, at the same time you want to make sure that you get stable return and the taxation, which is a very important aspect here. The taxation of arbitrage is of equity fund, which clearly means that any gain that you make within 1 year is taxed at 15%. Any gain that you make after 1 year is considered as long-term capital gain, where you have to pay 10% tax. Now compare that with a debt fund. In the debt fund, the short term is for 3 years. The long term becomes applicable only after 3 years. So in the short term, you pay tax at your applicable tax rate, which means that if you're an investor in a higher tax bracket, 20% or 30%, you end up paying 20 and 30%. And of course, even the returns can be a little volatile if you go into short-term fund or maybe fund that have a slightly longer duration portfolio. So I think anyone who's looking at parking, especially investors in the higher tax bracket of 20 and 30%, looking for an investment option where they want stability. Okay, and even though they are investing in equity market, I think this is a great opportunity for investors to look at arbitrage funds.
Okay, very important. This is not like your equity mutual funds where, you park your money and you keep it for the long haul. You have to have a slightly shorter term time horizon, maybe 5 odd years or
maybe even less than that, because the moment you go into 5 years, then you can start looking at hybrid funds.
Okay, all right.
I would say maybe 1 or 2 years.
Oh, okay.
Longer than that, there are different opportunities which are available to you.
Okay.
Because what you want is, because if you need money after a year or so, that means you need it for a purpose. So you don't want to take a risk on your capital. At the same time, what are you looking at? You want a return which is better than usually you get from traditional options like fixed deposits. Okay, because there also you get a lot of stability in terms of you know exactly how much return are you getting. So if you want that stability, maybe it doesn't say how much return will you get, but it's quite stable. I mean, if you really look at the performance of arbitrage fund over 1 year, 2 year, 3 year, 5 years, consistently the good performing ones have always given you 6.5% return.
Okay.
There may be periods where it can maybe go up and down, but if I look at the average, the average return has been around 6.5% over 1, 2, 3 and 5 years.
Okay, so not bad, stable returns, but I think it's still, compared to a regular equity fund, the return potential is a little lesser, I suppose, because of the whole risk component, because 6.5%, and I think from an equity mutual fund, of course, this year has been disastrous, but if you look at it from a long term, a CAGR of 12% is quite reasonable. But 1 year, 2 year time horizon, it's great because of the tax efficiency. I think you've been mentioning.
Because
very tax efficient.
You're not in a position to take risk. When I'm investing in equity for 5 years or 10 years, I know that I have time on my side. And also if I may be investing through SIP or in a disciplined manner. So there is an opportunity for me to in fact take advantage of the volatility in the equity market. But here, because my time horizon is shorter, I don't want that volatility that usually comes with the equity fund. So I'm looking at something which is stable, at the same time give me slightly higher return than what I get from, let's say, liquid fund. I'm talking about post-tax return. So obviously there I think arbitrage fund really fits in very well.
Okay, all right. So there is tax efficiency because it's treated like an equity fund, not like a debt fund, but the time horizon is almost like one of these fixed income funds or debt funds, 1 to 2 odd years. There's something called a side pocketing of mutual funds. It's a topic we spoke about 2 weeks ago as well. And now we understand that some of these arbitrage mutual fund holders, managers as well, have been indulging in side pocketing. What exactly is that, and what does it mean for an investor who has money in an arbitrage MF?
No, see, typically what happens in a debt fund, we've seen that there have been some defaults, or there are some securities where, the fund manager expects that there is some trouble over there. So the SEBI has allowed fund managers to do side pocketing of that. So typically what used to happen is that earlier, if there is a default by the company, everyone used to suffer, one. The second is if you took out your money from a debt fund, and then you never used to get that recovery as far as you are concerned as an investor. So side pocketing means you're keeping money aside in a separate account. Even if you exit, and if that money comes back, you will still get that money back. So that's a difference in that. But arbitrage fund, because generally they are investing in equity, so I don't think really you will see an occasion where fund manager really have to resort to side pocketing.
Side pocketing. Okay. Now you mentioned arbitrage funds make money when there's a lot of volatility in the market. So that means, is it that when the markets are quiet and there's not much happening, then one should stay away from arbitrage funds?
No, I'm not saying that. What I'm saying is you may have to compromise a little on the return. The fact that there is always a mispricing between the cash market and the future market. So I think there will be an opportunity for the fund manager to make money. How much return he makes will depend on the level of volatility in the stock market. If there is more volatility, there is more mispricing, more opportunity for the fund manager to make money. If not, maybe the return can come down a bit. So like I said, I think the key factor is post-tax return of arbitrage fund. Like let's take, let's say, liquid fund. If you get 6% there and you get 6% in arbitrage fund, if you're in a higher tax bracket of 30%, your net return is not going to be more than 4. A post-tax return is not going to be more than 4%. And look at arbitrage fund. Because you're paying 10% long-term capital gain, your post-tax return is going to be 5.4. For a time horizon of 1.5, 2 years, if you can make that much difference to your return, I think that really means a lot.
Means a lot. Okay, all right. So right now then, for all our retail investors watching, would you advise an arbitrage fund then?
I don't think it really makes sense for a retail investor to look at arbitrage fund, for a simple reason that even liquid fund can give you the similar return. And obviously, because the tax is not an issue with them, so investors who are not paying tax or investors who are paying 10% tax, for example, they may end up paying 15% here because the short-term is taxed at 15%.
Yeah.
So I think the investors in the lower tax bracket should stick to maybe liquid fund or ultra short-term fund. But investors in the tax bracket of 20% and 30% should certainly be looking at arbitrage funds.
Okay, all right. So, folks, I hope we've given you a good enough introduction into the world of arbitrage funds. And Hemant, of course, has given his advice based on what your tax bracket as well is, because, it's very important that you take that into consideration when you're holistically designing your portfolio. And now, of course, we will kickstart Ask the Money show. This is, of course, the part of the show where we invite all our viewer queries. So if you have any questions or queries on arbitrage mutual funds, on your portfolio, call in right now 24990300, or you can email us. We'll prefer a live call. Instantaneous answer is what you will get there. For now, let's take on board our first viewer query. We have Mr. Dhaval Bora, who has written in to us saying that I have the following mutual funds. I've invested for 15 years and can take more risk. He wants to know if the portfolio is okay. It looks like his aim is wealth creation, because he's not mentioned anything otherwise, no specific goals as such. There's the Franklin India Blue Chip and the India Equity. There's the HDFC Equity, so all three large cap funds. Then there's the HDFC Top 100, HDFC Hybrid Equity, HDFC Mid Cap Opportunities, and then Reliance Value Fund and Small Cap. He's clearly a big fan of Mr. Prashant Jain and his Hybrid Equity, HDFC Mid Cap Opportunities, and then Reliance Value Fund and Small Cap. He's clearly a big fan of Mr. Prashant Jain and his team. HDFC, lots of HDFC fund houses over there, and then a few small cap and mid cap names. But it's mostly skewed towards the large cap, funds. How would you view his portfolio here?
I think two important things here. One, the time horizon is 15 years, so it really makes a lot of sense to invest in equity, which is what he's doing. He's not mentioned whether he's investing through SIP or a lump sum. Assuming that his time horizon is 15 years, I think it's a great thing that he has done. That is build a portfolio of equity fund. Now the thing is, there are too many funds, I believe. There is a need for him to consolidate the portfolio. As you rightly mentioned, almost 36% is invested in Franklin, 46% roughly around in, I think, HDFC.
In HDFC,
and then a small exposure, around 15% in Reliance, which is now Nippon India. So this is how the breakup is. So I would, recommend a few changes in the portfolio. One, the Franklin India Blue Chip Fund hasn't been doing that well for quite some time. So, my suggestion would be to move out of that. Second is HDFC Hybrid Fund. 20% is invested in hybrid fund. When your time horizon is 15 years, it doesn't make sense for you to put some money in hybrid fund. The reason for that is a very small percentage goes into debt. So it's neither here nor there. Then there are two funds in small and mid cap, very small percentage there. In all put together, I think 5 or 6%. So I believe that he should exit from these 4 funds. Look at 2 options. One is excess mid cap, one of the best mid cap funds in the category.
It's done very well as well.
It's done very well. And the second is a multi cap fund, which is Kotak Standard Multi Cap. So instead of 4, he should be looking at these 2 funds. Another option for him is that, another suggestion for him would be that his money is lying in Franklin India Equity Fund. I feel that the Franklin India Focus Fund will be a better option. So maybe he should switch his money from equity to focus. I
think it's managed by Mr. Anand Radhakrishnan
so I think
himself.
These are few changes that if he can look at, I think he can get better return. The portfolio will also be more
crisp, because you're eliminating 4 and you're adding 2, so it makes it also, I think,
at least you're reducing 2 funds.
2 funds are being reduced. Yes. Okay. So that's the recommendations. Please do take note of that, Dhaval. Too many HDFCs, so be wary of that. Okay, we have Sunil joining us on the phone line from Pune. Hi Sunil, good evening. Thank you for calling in. What's your query?
Hi, good evening. I would like to know what's the difference between liquid fund and money market fund.
Okay.
I have invested into, so that's the question number 1.
Okay.
And second question is, I invested into HDFC money market fund.
Okay.
My time horizon is 2 years.
3 years.
Is it likely that like liquid fund, the HDFC money market fund returns will also go down? And does it make sense to exit that and get into some other debt fund?
Okay, all right. So he wants to know the difference between the liquid fund and a money market fund, and he already has his money, in fact, in an HDFC money market fund. Is that right, Sunil, what you mentioned?
Yeah.
Yeah, in an HDFC money market fund, and he has a time horizon of 3 years. So he wants to know basically on what you think of the fund and your review of the fund.
I think first thing I would say that either investing in money market fund or liquid fund for 3 years, I don't think is a great idea.
Yeah.
These funds are basically meant if your time horizon is maybe a couple of months. Beyond that, if you keep invested in these kind of fund, you're actually compromising on the return. So my recommendation would be that he should be looking at something else, maybe short-term funds, or if he wants to look beyond debt funds, maybe look at some hybrid funds. Okay. There are some hybrid funds like equity saving funds, which invest around 15 to 20% in equity, the rest in arbitrage and debt. I think that will be a great option. He can get much higher return than what he is getting from money market. As far as the difference is concerned in these two, money market, as the name suggests, invests only in the money market instrument. So time obviously more stable than even liquid fund. But even, of course, that means you also have to compromise a little bit on the return. So my recommendation is, if the time horizon is 3 years, definitely either look at short-term funds, or if he wants to look beyond debt funds, then maybe look at equity hybrid fund. I think that will be a much better option.
So usually I think liquid funds and money market funds are used by corporates, to park some of their money temporarily that they do have lying around extra. It's treasury management. As a retail investor, you have also a 3-year time horizon. So go in for a short-term duration fund or even a hybrid fund like Hemant has suggested, Sunil. I hope we've answered your query. Okay, we have S. Gupta from Shimla who's joining us on the phone line. Mr. Gupta, good evening. Thank you for calling us and watching the Money Show. What's your query, sir?
My query is about the global or foreign fund, the double taxation that we hear about.
Right.
Can we explain that what the double taxation is about and how it works?
This is for foreign funds, is it?
Foreign or global fund, right?
Okay, all right. Hemant, would you be able to help out our viewer?
So if he is talking about the international funds which are available from the
like for example
funds,
the Motilal Oswal.
See, what typically happens is any fund which invests less than 65% in domestic equity. Okay, the definition of an equity fund is any fund which invests 65% in domestic equity. That's where the tax, benefits of equity funds will come in. Any fund which is investing less than 65% in domestic equity, it could be either in India or outside, will be treated as a debt fund. So the tax implication or will be of a debt fund, because usually these are all fund of fund. They collect money from here and invest in an international fund. So the taxation is going to be of a debt fund, which if you just mentioned earlier that any gain that you make within 3 years is a short-term capital gain, where you end up paying tax at your applicable tax rate. Any gain that you make beyond 3 years is a long-term capital gain, where you get the benefit of indexation and you get 20% tax on that.
Okay, so just to understand, if you have invested less than 65% in your country's equity, then you are treated as a debt fund, is that right?
Yeah. See, how it has been defined is any fund which invests more than 65% is an equity fund for tax purposes.
Okay, all right.
All other funds are debt funds.
Debt funds, to keep it simple.
So this comes in debt fund category.
Okay, and the taxation treatment as well is accordingly, where if you have invested for under 3 years, then it will be a short-term capital gain, and if you have sold only after 3 years, then it's a long-term capital gain. I hope, Mr. Gupta, we have been able to answer your query. Okay, well, but unfortunately on that note, we're out of time on this edition of Ask the Money Show. If you still have any queries, please do write in to us on the Money Show at etnow.tv. We'll promise to get it answered. Hemant, thank you for joining us as well on enlightening us on arbitrage funds. Guys, please go ahead, do your homework, and of course take a decision accordingly. We'll take a quick break, but come right back as we're going to introduce you to the Samsung foldable screens very soon.